Broadcast is now starting. All attendees are in listen-only mode.
Hello, good morning, everybody, and welcome to the first of a 5 webinar series on an introduction to lean accounting. I'm Susan Lilly, and I'm going to be your technical facilitator today while the webinar is going on. Your presenter today will be Nick Kako, who is a senior consultant with BMA, has been involved in lean accounting for a long time, either as an employee of a company implementing lean accounting or with BMA since 2002. Nick has been a CFO. He's the author of the Lean CFO, the book, which if you haven't gotten it, you ought to. And himself holds a BA in accounting and is a I'm sorry, I have to read a little bit closer here. But Nick has also is a certified public accountant, holds a BS in accounting and an MBA in finance, both from the University of Kentucky. Currently resides, which is where you see his picture, in Lexington, Kentucky. A couple of technical things, and then we'll get Nick started. If you're having any kind of problem with audio or video, please use the chat pane on your control panel and chat me. Once again, my name is Susan Lilly, and you'll see me out there. If you are having any kind of problem, chat me about it, and I'll do my best to help you when I can. Nick has said that if you want to ask questions, you may ask your questions as they occur to you. Don't wait till the very end and put them into the question pane, which you can see in your control panel. And Nick will try to get to as many of them as possible. Okay, I believe that is it. And turning it over to you, Nick.
Thank you, Susan, and everyone, welcome to the first of 5 lean accounting webinars that we'll be conducting over the next 2 weeks. So let's get started. Today we're going to talk about exactly what is lean accounting, and then in the future sessions we're going to dive a little bit deeper. We'll be talking about how to create and use lean performance measurements on the next session. Session 3 will be how do we create and use the value stream income statement. Then we'll start putting the tools together in session 4, and we'll talk about how do we make good, sound, strategic types of business decisions using a box score in a lean company. And finally, in session 5, we'll talk about how lean manufacturing companies, when they move to lean accounting, how they deal with standard costing, and then we'll spend a little time on how do you actually create a lean accounting transformation plan. So let's get started. Today, we're going to talk about what is a lean management accounting system, which is really the foundation of lean accounting. I want to spend a few minutes talking about lean accounting thinking. How do you have to think to understand why lean accounting will work in a lean company? I'm going to talk about the economics of lean. How does lean work financially? There's a lot of books and everybody talks about how lean works operationally, but how does it really work financially? Talk about the conflict between traditional management accounting systems and lean companies. Then we'll wrap things up. We'll sort of outline what are the attributes and characteristics of a lean management accounting system, and then we'll take the questions. I'll answer as many questions as possible at the end. Lean accounting there's really 2 parts to lean accounting. Number 1 is the lean management accounting system. So these are lean focused measurements to control, manage, and improve value streams. Also about simple systems for reporting and analysis. One of the key aspects of lean accounting is linking lean operating performance to financial performance. We want to create a decision-making framework based on the economics of lean, which I'm going to explain in a few minutes, and we want to incorporate the financial benefits of lean into this framework. We really want to make this strong connection between how does lean work in an operational standpoint, from an operational standpoint, and how do we see those results financially. The final aspect of lean accounting is lean financial accounting, which is how do we manage flow and waste in all accounting processes to improve productivity, delivery, quality, and service. Lean accounting is primarily the lean management accounting system. And any good management accounting system controls and measures the business. In a lean company, that is your lean performance measurement system. The great part about your lean performance measurement system is that it's all visual. All the measures are posted in the business and they can be seen and they're updated frequently. The second part of a lean management accounting system is a decision-making framework. We want to create a financial analysis based on the economics of lean. We want to establish true cause and effect relationships between operations and financial results. What I like to tell customers and people who attend workshops and financial people and executives, if you want to see financial improvement, you have to make operational improvement. And that's the strong connection that lean accounting creates. And finally, from a customer viewpoint, and this is the accounting function, the finance function of the company, your internal customers, management, lean operations, and other folks, they want to understand the financial impact of all the improvements they're making. Additionally, they need this decision-making framework to support the lean strategy. Lean accounting thinking. A lot of people ask me, well, when do you start lean accounting? And you really start lean accounting when you start thinking like a lean accountant. And that is not just the accounting function. It can be executives, it can be lean operating people, it can be anyone. So it's really more of a mental shift in how you think about accounting that begins the lean accounting transformation. I'm a CPA and I've been a CFO, and when you're trained in accounting, which is a very technical field, you sort of learn how to think. And we are trained to think backwards because our primary training is based on understanding financial statements and being able to analyze financial statements. So I call this backward looking. The question we usually get at month end or year end is, how did we achieve the financial results? So we begin looking at the financial numbers. So again, we're working backwards and we're looking sort of historically at what happened. And when we get operations involved, we ask them to explain, well, what happened last month that created these financial results? Then we talk about what do we want the numbers to be. And then the traditional type thinking is, well, let's just try to make the numbers. How do we grow the revenue? How do we cut costs? So again, this is a financial accounting view of a business. Nothing wrong with it, because this is one of our main jobs, is being able to explain financial results. The conflict comes in when you look at how lean operations thinks. They're thinking forward. Lean operations, they want to understand, what is our current operating performance? What is it today? What was it yesterday? They're not too concerned about what happened last month or 2 years ago. They want to understand current performance so that they can identify problems and issues that are preventing improvement from occurring. In the lean context, this is called lean problem solving and root cause analysis. What lean operations then does is they work on actually making the physical improvements to a value stream or a process to change operating performance. And lean people are always looking ahead in terms of what the numbers can be. For example, how can we improve productivity 20% annually forever? How can we improve quality 30% a year? So is this cycle of improvement. And so they're focusing on making the numbers operationally. What lean practitioners understand is that if you improve operating performance, you will improve financial performance. So to begin thinking like a lean accountant, we have to begin thinking forward. So let's start. We start again, what is our current financial performance? The change, instead of just looking at the financial statements, is to identify the operational problems that are preventing financial performance from improving. Now, this isn't something that just the accounting folks do. This is a joint effort between accounting, operations, and senior management. Solve the operational problems that are preventing financial performance from improving. Look ahead in terms of a relationship between improving operating performance and improving financial performance. What is that relationship? And then focus on making the numbers. So it's really key for accounting folks, senior executives, and operational people to understand that the way that an organization and individuals thinks about the accounting function must change in a lean company for lean accounting to take hold. There are 4 aspects to lean accounting thinking. Number 1 is understand lean financially. I'm going to explain that in a few minutes. Second, from an accounting viewpoint, serve your internal customers. Lean companies focus on creating value for their external customers. So a mental change for accounting is to focus on what your customers need. And lean operations, they need specific information to understand the business. And it's our job to serve our customers. Third, your management accounting system must change. That is an absolute, I would go as far as saying that's a non-negotiable. If you work in a lean company, the accounting function sort of manages the management accounting function. They provide a lot of the information, they do the analysis, they're the caretakers of this system. This system must change to adapt to a lean business strategy, and accounting needs to lead this effort. And finally, lean accounting does not impact financial reporting. I've heard lots of people talk to me about this, that they think that it means that we're changing the way we report our financials. That is not, it is simply not true. Financial reporting doesn't change. Lean accounting does not impact the way we comply with our financial reporting requirements. So let's move on to the economics of lean. As I mentioned a few minutes ago, understanding lean from an operational view in terms of creating flow and eliminating waste and doing Kaizen events, it's all well documented and lots of literature, lots of things online about that. And when you try to understand lean accounting, it's really important to understand how lean works financially. I like to call this the economics of lean because it's a very simple concept. And when accounting understands this concept, when everyone in the organization understands this concept, it's a whole lot easier to understand why we have to make all these changes in our business. Lean is a financial growth strategy. It is not a cost-cutting activity. It is a long-term strategy. In fact, once you adopt a lean strategy, that pretty much is your strategy for the rest of the organization's life, because you never stop trying to be better in terms of being lean. How does it work? In general, and at a very high level, we try to eliminate waste through this continuous improvement process. The elimination of waste creates capacity or time. Lean companies use that capacity to sell more products and or services. Another aspect of lean is that managing flow manages your costs. And finally, we use all of this effort because we're trying to create more value for our customers or our clients, and we grow revenue. Lean is primarily a revenue growth strategy, and that's important to understand. The economics of lean. Think of your introductory economics class, supply and demand. Let's start with the demand side. The primary goal of a lean strategy is to deliver value to your customers. In fact, when companies employ lean practices and transform into a lean company, they typically get better at delivering value compared to their history and compared to the competition. What this results in is that your revenue growth rate increases from your historical averages, and you also typically gain market share. On the supply side, think about the supply of your resources, the people, the machines, the technology that do the work to create the value. The idea of continuous improvement, and all of these resources work in different processes. So the processes are improving, and you're creating productivity, and what happens is your growth rate of costs slows down. What you end up with is your revenue maybe used to grow at 5%, and now your revenue is growing at 15 or 20% a year, and your costs might be growing at 3 to 5% a year. So if your revenue is growing at 15% a year, your costs are growing at 5% a year, you're going to make more money over time. And that, in a very simple way, that's the economics of lean. And I urge any company that is in the lean journey or maybe beginning the lean journey is to explain lean financially in those ways. Don't worry about Kaizen event. Don't worry about how to try to link Kaizen events to financial performance at this point. Just understand lean from the economic of lean perspective. So here's a simple example of how the economics of lean works. So we have a value stream that sells 1,000 units a month at $200. So the monthly revenue is $200,000. The actual material cost is $120,000. Our actual production costs are $60,000. That generates a 10% profit, or $20,000 a month. Through lean practices, let's say we create 20% more capacity, and we are able now to sell 1,200 units a month. What's the financial impact? What is the additional cost of those 200 units? Well, our revenue goes up to 240,000. Our material cost goes up because we're selling more product to 144,000. Our production costs, however, stay the same. We have created capacity, And because we have created capacity in our existing resources, our actual production costs don't go up. So now our profit is now $36,000 a month rather than $20,000 a month. So our revenues increase 20%, our profits and our cash increases 80%. This is how lean works financially. It's important to remember that the rate of flow through a lean organization is how you generate profits. People often ask me, how much money can we make with lean? The answer is, how fast can you flow? The rate of flow will dictate the rate of profitability. The faster you flow the orders or flow the services through the value streams, the more revenue you will generate. The other great part about the rate of flow is that the faster you flow, it really makes you a low-cost producer. Every company would like to be a low-cost producer. The typical way is to look at, well, how do we reduce our costs? And again, we start with the financial statements and how do we just reduce our costs 5, 10, 20%. And lean companies don't work that way. Lean companies know that the faster they flow, the better the costs will be managed. And finally, managing flow creates this long-term profitable growth strategy. So that's the way the economics of lean works. So now let's change direction. Let's talk about the conflict between traditional management accounting and lean practices. Traditional management accounting systems, which primarily were developed in the early to mid 20th century when mass production manufacturing was prevalent, traditional management accounting systems don't work well in lean companies. In fact, they don't work at all. Why? They actively work against continuous improvement. And I'm going to show you an example of this. They give you the wrong information. The systems are expensive and wasteful compared to what a lean management accounting system can be like. Provides incorrect information. And finally, it's very complex and confusing to people, including some finance people. So let's look at some real-life examples. Working against continuous improvement. So I'm going to give you a very simple production process. That there's a drilling process on a CNC machine that takes 1 minute, and it works in a batch of 2,500. There's a lathing process that takes 4 minutes. There's a grinding process that takes 6 minutes. And finally, inspect, pack, and ship, which takes 4 minutes. So that's the current state of the production process. If you look on the lower right-hand side, you'll see operational information. A 6-week lead time, 25 days of inventory, a 10 days of a batch size of 2,500, and on-time delivery of only 82%. Not very good in terms of operating performance. On the lower left side, you see some product cost information that based on a total labor time of 15 minutes, we have $5 in labor cost, an overhead rate gives us $15 of overhead, material cost is $1.50, total cost $21.50. So that's the current state. When we create a lean cell, and this is an actual example, is that the drilling machine, the CNC machine is replaced by a drilling machine, and it now takes 4 minutes instead of 1 minute. The lathing process takes 4 minutes and continues to be the same. The grinding process is 6 minutes, and inspect and pack takes 4 minutes. So we replace the large machine with a smaller machine that gives us quick changeover. We've reduced batch size, lead time, and inventory. But we still have the same resources except for a smaller machine. If we look on the right side, we see that our operational improvements have improved dramatically. A lead time of 2 days, inventory of 5 days, a batch size of 250, on-time delivery of 98%. However, from a cost viewpoint, which is based on labor time, the labor time has increased from 15 minutes to 18 minutes, and that has increased the cost. And that really, it increased the cost of the product, but it didn't increase the cost of the value stream. And that's just an example of incorrect information. Here's another example about how expensive and wasteful a traditional management accounting system is. Let's look at work orders, which are used extensively in manufacturing businesses. You have to close out the work order to put the product in the finished goods. The work orders travel with shop packets all over the shop floor, and they have to be maintained. Work orders are used to value inventory and control inventory in terms of reporting transactions. Not really used in customer service that much, maybe except for tracking where an order is in the system. A work order will tell that. Tracking labor, adding hours by operator code. Information technology, well, they have to maintain the whole system, and they get asked lots of questions about why the work orders aren't working. Planning, they launch production using work orders. And finally, accounting, they use work orders and all the information that the work orders produce to cost products and value inventory. So this is a very, very complex system that requires infrastructure, it requires people to enter transactions, and it requires maintenance and analysis of all the information. Third, incorrect information. Here's another example using product costs. So we have product A. It has a standard cost of $90.06 based on $42 of material, labor time of 17 minutes, and an overhead cost of 600%. The actual cost, however, inside the value stream is $100 based on the material cost of $42 a unit and an hourly production cost of $580, and you can make 10 units an hour, so it's $58. So in this case, the actual cost is greater than the standard. Now, if you look at another product which is made in this value stream, product B, it's very similar to product A. The primary difference is that it takes a little bit longer to make. Instead of 17 minutes, it takes 24 minutes to make. What that does is that creates a standard cost of a little less than $110. But the actual cost, because you can make 10 units an hour, is still the same. So the incorrect information is that you're looking at products that flow and probably are very similar in nature, yet their standard costs are wildly different. And we're trying to make decisions on profitability of products, whether to insource or whether to outsource. And I'm sure if you work in a manufacturing company and you use standard costing systems, you can see lots of these examples inside your business. This really confuses non-financial people. It confuses operating people, confuses sales and marketing people that are trying to understand product profitability, and really it drives the accounting people crazy because they have to try to explain this. We also have this overhead spiral of death. Now, this slide that you see is something that was given to me by the Boeing company, and they did some work on this a few years ago. And again, many of you in manufacturing may have experienced this, where that the distortion of the overhead costs that are assigned to products makes companies sometimes want to outsource products or discontinue products. And the trap or the spiral of death is that if you discontinue products or outsource products because of perceived high overhead costs, that raises the overhead costs of all the remaining products and they become less profitable, and then you try to discontinue or outsource more. And that's known as the spiral of death. And maybe some of you have experienced that in your careers or your businesses. The complexity and the confusion of a traditional management accounting system primarily is around setting rates, labor rates and overhead rates and inputs and reporting. Again, this is a slide from Boeing and gives you examples of how many overhead rates that they set for different programs and how many direct labor rates they had. And the management and the maintenance of the rates is really a full-time job for a lot of people in companies. So to wrap things up about the conflict, we've talked about all the reasons why a traditional management accounting system doesn't work in a lean company. What we have to remember is in lean, it's all about flow. The profitability of a business, a lean business, or the profitability of a value stream in a business is determined by the rate of flow of orders through the value stream. Cost control. Measuring and managing flow is how you control costs. Cost reduction is achieved by eliminating waste. Now, it's very difficult to do significant cost reduction in any business. It's really about more cost control. But you eliminate waste, you will achieve some cost reduction. And finally, it's all about profitable growth. Increase the demand by creating value, use the available capacity. So a traditional management accounting system really doesn't give us the information to understand profitability by value stream, to understand how to measure and manage flow, or to understand how to achieve profitable growth. So let's talk about the attributes of a lean management accounting system. First of all, let's talk about, before we talk about the specifics of lean accounting, let's talk about a lean strategy. A lean business strategy is really about changing systems to achieve financial results. Lean companies typically start, what I want to say is backwards. What kind of results do we need to measure and manage and we need to look for? And it's all about delivering customer value. That's where lean begins. How do we have high quality, the highest quality in our industry? How do we have the highest on-time delivery in our industry? How do we have the shortest lead times? And how do we have overall organizational productivity? Not just if it's a factory, if it's a manufacturing company, it's not just the shop floor productivity, it's the entire business. We're looking at productivity everywhere. And productivity is simply increasing output with existing resources. And finally, we want to align behaviors, organizational behaviors with this strategy. What are the organizational behaviors we're looking for? We want to be make to order. We want short lead times. We want visual controls. We want to drive continuous improvement through lean problem-solving methodologies. And we want to be relentless about the elimination of waste everywhere in the business. So therefore, What do we measure? We typically, in a lean company, measure flow, quality, productivity, delivery, and cost. These are the process measurements. Because we understand that if we provide superior value to our customers, revenue will grow. And if we manage flow and eliminate waste, we will eliminate our costs. I was very fortunate as a CFO in the 1990s to really experience this. We were a typical manufacturing company that at the time was about 70, 75 years old, had mature products, sold well. We made money. We had good sales. We had a comfortable profit. But when we did it, we completed our lean transformation, and our lead times went down to 3 days from like 21 days. When our on-time delivery went from 70% to 98%, we really provided the value that our customers wanted, and our revenue growth, which if it grew at 5% a year, we were very happy. Now our revenue was growing at 20% a year, and we were wildly profitable. We had all kinds of cash, and we were able to pay down debt, pay off all our notes. We could invest in our factory the way we wanted to. So this is real, the way that lean works, and it's very, very important for the management accounting system to match up with the lean strategy. So the elements of a lean accounting system is lean performance measurements. We want these measurements to be integrated with strategy, and we want these measurements to drive actions. Now, many of you, if you currently work in a lean company, you may already have lean performance measurements in place. That's great. If you are in finance in a lean company, then I urge you to learn about the lean performance measurement system. That's really what we're going to be talking about tomorrow. But the idea is to integrate performance measurements to drive problem solving and improvement. We want to understand profitability by value stream inside a lean company. Value streams are the profit centers of a lean business. And from a lean operational viewpoint, we focus on the rate of flow inside the value stream. That will drive profitability. So a lean management accounting system, the financial basis of that is a value stream income statement. And then we now are aligning the organizational structure, which is value streams, to the profitability. And in session 3, we'll talk about how we create and use a value stream income statement. The box score, which is 3 categories of information: the performance measurements, the value stream income statement, and value stream capacity. We look at all 3 elements of the box score in harmony when we're looking at understanding performance or making decisions. And we want to integrate the box score into the lean decision-making fabric of an organization, all the way from executives down to the shop floor. The box score serves as the information to make just about any business decision in a lean company. And part of the lean accounting transformation is to introduce the box score and begin using it to make decisions. When the box score gets introduced and it becomes the standard work for lean decision making, it really unlocks the financial potential of lean in terms of growing revenue and managing costs. And finally, eliminating transaction and unnecessary work. When you transform from a traditional management accounting system to a lean management accounting system, your old management accounting system really goes away. And so you free up a lot of a lot of capacity in terms of maintaining the old management accounting system, reporting transactions, or unneeded work. And so you free up the time of people in the factory. If you are a manufacturing company, you free up a lot of time in accounting, and it benefits everyone. So the attributes of a lean accounting system. One is that we want our accounting processes to support the lean business strategy. Performance measurements, value stream costing, and such. Secondly, we want to provide clear and timely communication, what we like to call plain English financial statements. Obviously, that's not applicable to anyone listening that is in a different country, but the idea is to create simple, easy to understand internal financial statements that are designed for non-financial people to understand. That's the idea behind calling it plain English. Remember, we want to serve our internal customers, so we need to provide them financial statements that they understand and can relate their operational activities to. And finally, we're looking at incremental cost and profitability analysis. When we make business decisions, what's the actual change? If we make a certain business decision, then what is the incremental change to profitability, costs, and revenue? That's what we want to understand. Finally, planning from a lean viewpoint. Our value stream capacity gives us a lot of opportunity to look at what is the impact of improvement, what is the impact of additional demand on the system, and allows us to look forward and understand how possibly can our costs change if our revenue grows and we need more capacity. And like I've talked about a few times already, we want to integrate box scores into all business decisions and planning. Just to wrap things up, we're trying to create lean and simple business accounting. We want to improve our management accounting system, and we want to solve problems inside that. We want to actually strengthen our overall internal control system. Lean controls do a great deal better of controlling a business than old transactional controls. So we're in the wrap-up stage here, and I'll open it up for questions in a little bit. I wanted to put this up here and explain something that if you want to attend, if you haven't registered for the remaining 4 webinars and would like to, you have to register for each of those individually. So go back to your original webinar invitation email, click on the registration link, and then you'll see a drop-down screen that shows the date of the webinar. So for example, if you registered for today's webinar, but you haven't registered for Thursday's webinar, go back and register for Thursday's if you want, and you have to repeat this each time. Sorry, that's the way the GoToWebinar software works when you do a series of webinars that are linked. And again, no one has to register for, you can register for all of them, one of them, 2 of them, whatever you want. So I just wanted to mention that. And if anyone has any questions, you can contact me via email. So here's a little, before I open it up for questions, here's a little bit of information about BMA. There's our website, there's my email address, there's lots of free information on our website to download. Wanted to talk about some upcoming workshops that Lean Frontiers and I are holding on lean accounting, June 18th, 2018 in Venice, Italy, and September 19th, 2018, Jekyll Island, Florida at the annual Lean Accounting Summit. If you go to the Lean Frontiers website, you can use the promo code BMA and they'll give you a little bit of a discount to register for either of those events. Also, we have a lean accounting group on LinkedIn. You're free to join, and we post blogs there and other information. So I'm going to open up my pane here and see if we have any questions. And so I'm going to start answering the questions. So the second question is that, hold on one second. All right, sorry. So this question says, does lean assume that capacity is the constraint? I guess the short answer is yes, capacity is always a constraint. And in lean operations, they call that the bottleneck operation. That is the operational process that has the least available capacity, or it has the capacity that takes that, or it has the cycle time that takes the longest. The second question about calculating rate of flow later, or am I going to talk about that? Yes, in the performance measurement webinar tomorrow, we're going to talk about how do we measure and manage flow. The third question is, what is an example on how to measure flow within a sales environment or distribution environment? Well, in terms of distribution, the flow would be from the time the order is received until the time the product or the product is shipped or received by the customer. In a sales environment, and I would assume you're talking about the sales function, this is where you could measure, for example, the quote process. How long does it take from the time a customer wants a quote to the time you deliver a quote? You really can't control how fast a customer responds to a quote, but you sort of have to think about what aspects of flow do we want to measure. And I'll think about a little bit more on this and answer it a little bit more tomorrow. Next question. So how are lean accounting system attributes different from activity-based costing? That's a very good question. Lean accounting, we really don't measure product costs any longer in lean accounting. Activity-based costing is really a system where you take activities and break down the cost drivers, and you're still trying to get to a product cost, or you're trying to get maybe to a specific activity cost. Either one, I've seen both. The primary difference between lean accounting and activity-based costing systems is that lean accounting tries to minimize the allocation of costs. When you allocate costs, it's based on an assumption. That assumption may not be valid, or it requires a tremendous amount of resources to understand the validity of the assumption. And when we talk about value stream profitability, we'll be talking about cost allocations in more detail. Another question: how does one get the accounting function and associated management, CFO, to embrace lean accounting as part of an overall lean transformation? Excellent question. I would say the first step is lean education. That the accounting function or the leaders in any accounting department, they need to understand how lean works as a business strategy. They need to understand how it works operationally. They also need to understand why a company is adopting a lean business strategy. So it's really about one of the earlier slides I talked about. How do we get people to think like lean accountants? I do recommend that it's important not to sort of tell the accounting function that they're doing things wrong, um, and tell them that it's bad for lean. Because again, we're trying to educate people on lean first. And if you can educate the people on lean, the accounting people, then they'll begin to understand how systems need to change. I'm looking, got a few more questions here. So, how does lean accounting align with generally accepted accounting principles? And if it doesn't, how are you going to change the profession? Very good question. Lean accounting is a lean management accounting system. Management accounting systems are not governed by generally accepted accounting principles or international financial reporting standards. That's financial accounting and financial reporting. Management accounting systems are designed by companies for their company to use. So again, we're not talking about changing financial reporting. We're not trying to create a new kind of accounting here. It's primarily management accounting. Another question here, will we receive a copy of the presentation? As a reminder, if you look under the handout section of your webinar toolbox, it says handouts 5 of 5. All of the webinar PowerPoint presentations are there, and that's how you can get a copy. If by some chance you still can't get it, contact me. That's another question. And let's see. At what stage do you introduce lean accounting? Lean accounting should be introduced at the beginning of the lean journey. Lean is a journey, not a destination, and lean accounting should be implemented at the rate that lean gets implemented. And we'll talk a lot about this in webinar session number 5. So another question, this is from Gary Kapanowski. The question is, for lean transformation failures in organizations, is it due to the people cultural side of lean or the lack of lean accounting and the financial structure to sustain lean? I would say lean probably fails more from the people cultural side than the lean accounting side. But I do think that at some point you need to transform the information in lean so that the people understand what they're being measured on. Another question. In some companies, I see lean consultants under finance, while for some companies, lean consultants are under operations. Which is better? I would say the best solution is to have a lean steering team or some kind of lean management team, which might be your executive team or some subset of the executive team, and it should be cross-functional. So you want operational people there. You probably also want some finance person represented on this lean steering team. And the lean consultants ultimately have to have a report to this lean steering team on a regular basis. Another question. The next session is Thursday, the 18th of January. And we still have some more time, so I'll keep going with the questions. Here's another one. Is it a company challenge to drive lean culture across the organization? Do you have some tips in lean deployment in an organization to change the mindset of people? Yes. Let me say one thing about culture. And the easiest way to change a culture is to change the expectations. It's not something that's going to happen overnight. Lean principles, lean practices, lean methodologies really change expectations. The challenge in any company is that those to become the new expectations in terms of looking at flow and eliminating waste and doing Kaizen events. And you have to get rid of the old expectations. Another question about accessing the section where presentations are available. That is the handout section. Let's talk. We still have about 5 more minutes left. Here's a question about standard costing. Does standard cost accounting continue in organizations for financial reporting, but change strategy towards lean accounting for operations and management accounting? Very good question. The short answer is that cost accounting can continue for inventory valuation purposes, which is really what cost accounting is designed to do. Webinar number 5 is going to address this issue specifically about how do we actually transform inventory valuation into a lean inventory valuation system with the opportunity to turn off standard costing. I, as a CFO, did turn off standard costing, and I've also worked with a few companies that have, and that's going to be in webinar 5. All right, is there, let me see, I'm looking at, so there's a wealth of tools and training available to implement lean tools. What training opportunities are available to train CFOs in lean accounting? Well, we have webinars like this. We do workshops, we do training, online training, we do actual consulting. It's not just us. There's other people out there that do lean accounting training. There's also some good books. Look on the BMA website for some of those books, please. And let's see. I'm looking for a few more questions. And I think that really wraps things up. The last question, will there be an upcoming webinar to discuss the box score in detail? Webinar on Thursday talks about performance measurements in detail. Next Tuesday's webinar talks about value stream income statement in detail. Then next Thursday, we'll talk about the box score in detail. So that wraps things up, and I appreciate you for attending, and hopefully we will see you all again on Thursday.
Goodbye, everybody.
Susan, can you hear me?
I can, yes, I can. And since the webinar is still going on, so can the remaining people that are out there. If you want to go into your control panel and choose the word file, there ought to be a way to terminate the webinar for the people, but you can just wait. Had a really good audience today, Nick. 180 some people. Very, very good. And lots of questions. I congratulate all the people on their questions. That was very nice.
I can't see where that.
Yeah. Another possibility that you can do in order to take care of that would be to open the attendee pane and simply start going down the list and right click, or you don't have, you're an Apple, but you should have a way to have have people leave.
Anyway, thanks for your help, and
I appreciate it. See you on Thursday. I think it worked out very well. When I see you on Thursday morning, I have a couple of other things to discuss with you, but it can wait.
okay, bye-bye.
See you later. See you later, Nick. Bye now.